Hello, Matthew Copley here with Copley Financial Group, and today we're going to do a market update, get you up to speed on what we're seeing as far as economic data and what changes we're making to our clients' investment accounts in order to make the most out of it. We're going to cover some of the leading economic indicators, some of the lagging economic indicators, what the differences are. We're going to talk about specific investments, specific returns that we're seeing now. And we're going to share with you some of the things we're seeing as serious financial concerns going forward in the marketplace. We are really seeing mixed signals in a lot of the economic data. The government reports that we have gotten recently have been very strong. The GDP report has come in stronger than expected. Unemployment is better. The JOLTS report, which just came out this morning, significantly better than expected. And so when we look at the government economic reports, some of the data says, hey, the economy is good, everything's looking great, no problems. But then when you start to dive a little bit deeper into that data, you start to realize there is some underlying problems. For example, when we look at the unemployment data, it tells us that full-time jobs are actually contracting. There are fewer full-time jobs today than there was a year ago. And you look at part-time jobs, those are where all the increases are coming in the unemployment data. As far as the job openings, the JOLTS data, what we're seeing is all of the job opening gains are in government jobs. So obviously the government jobs do not typically produce a whole lot for the economy like private sector jobs. In fact, some of the government jobs actually take away from the private sector. So that is really not good data when we start looking at underlying JOLT report and unemployment. Then we look at GDP. We're looking at the trade deficit as being extremely large. And when you see trade deficits the way they are, it actually helps the GDP look better than it actually is, because the US dollar has been pretty strong against foreign currencies, especially the yen and other currencies around the world. And so the underlying data tells a little bit different story than the headline numbers on the government reports. And just anecdotally, here locally, I'm looking at economic numbers. One of the things that I'm interested in is the lease on our current office is up at the end of 2025. So I'm trying to figure out what options we have at the end of 2025. Do we move to a different location, maybe that is going to work out better for our office, a big new office, or possibly do we buy a building? Do we build a building? So looking at some of the data and seeing and talking to people within the industry, things are still going well. The architects are still doing a lot of drawings. Permits are still being pulled. There's still a lot of economic data going on. Now, obviously, the costs are a lot higher. Just a few years ago, it was $150 to $200 a square foot to really build anything. And today it's $400 to $500 a square foot. So there's been a significant increase in costs. And we're still seeing a lot of delays in materials. Steel, for example, 2-3 months out to get steel. So I still see some economic data and things that I'm seeing anecdotally here in San Diego that tells me the economy is still strong. But there are other signals that what we call leading economic indicators that are starting to become worrisome. It's important to understand the difference between leading and lagging economic indicators. A lagging economic indicator are things like unemployment data, the reports we were just talking about. Those kind of tell a story of what has already happened. Leading economic indicators are indicators that kind of tell us what may be going on in the future. And some of the leading economic indicators that I've been watching are a little worrisome. We're looking, for example, at credit card delinquency rates, which are really, really high. In fact, it's above 10%, which is typically a precursor for a major economic recession. We now have over 10% of all credit card payments that are, people can't even make the minimum payment on their credit card. That is a very concerning figure. Another concern that I have is what are called 401k hardship withdrawals are up over 40% over the last year. These are people that have to take a withdrawal from their 401k. And this is typically a big problem because especially people under 59 and a half have to pay a 10% penalty, you have to pay a bunch of taxes. And so this is kind of a last resort thing that you tap into is your 401ks. And the number one reason cited for these 401k withdrawals is people that are trying to stave off foreclosure. So this is a concern that people are pulling money out of their 401ks on hardship withdrawals to try to stop foreclosure. And this is a concern because the narrative that we all hear is, oh, the housing market's just fine. Everyone has these 3% mortgages, and so they're not going to go anywhere. They're not going to sell the house. The house prices are going to stay up because there's going to be limited inventory. But the problem is if people can't even make the payment on those mortgages that have 3% interest rates, then what happens going forward? Another big concern that I have is the returns in the stock market and where they're coming from. If we look at the stock market, people are going to say, oh, the S&P 500 is up 14% this year. Oh, the Dow is up 9% this year. Everything's great. The stock market's great. But when you look at the 14% return on the S&P 500, that is what is called a market-weighted return. And unfortunately, the top 6 companies in the S&P 500 have gotten the lion's share of all of the returns this year. In fact, if you look at what's called an equal weight, how the average company has performed over the course of this year, the stock market's only up 3%. That is a huge divergence. 14% on a market-weighted return and only 3% on an equal-weighted return. That is another precursor for a recession. We see these kind of narrow breadth indicators right before big drops. We saw it in 2007. We saw it in 1999. We saw it, of course, in 1929. And we now have the largest number. In fact, the top 6 companies in the S&P 500 now represent 35% of the entire stock market. This is extremely worrisome that just a few companies represent such a large share of the stock market. And one of those companies, the big one, that's now the largest company in the world, NVIDIA, this is kind of the big one that everyone's been bidding up. This company reminds me of Cisco Systems in 1999. In fact, back then in 1999, Cisco was the company that was responsible for all the infrastructure on the build out of the internet. And their stock price just went way up. It really shot up, especially in late 1999, early 2000. The stock price just kept going straight to the moon, very similar to the chart that we're seeing right now on NVIDIA. And ultimately, that company, everyone said, oh, they're the future, everything's great, their profit margins are 70%, they're should be the most valuable company in the world. And ultimately, their stock price crashed 85% within the next 2 years. And I honestly believe that's exactly what we're going to see with NVIDIA. Over the next couple of years, we'll probably see somewhere around an 85% drop in the stock price. Now, maybe it'll be 70%, maybe it'll be 90%, but it'll be very similar to what we saw with Cisco in the dot-com bubble. And when you look at NVIDIA, right now it's trading at 100% more than the 200-day moving average of the stock price. From a technical standpoint, that is very dangerous. It's actually greater than Cisco ever got to during the big bubble and the dot-com bubble. 100% over 200-day moving average is really just a crazy number. And I really think we're starting to see a problem. And when we look at the charts, I see what we typically call a bear flag forming in the chart on NVIDIA, and this could actually lead to a big drop in the S&P 500 on a market-weighted basis, just because NVIDIA is such a large share of the S&P 500. Now, some of you might be saying, wait a minute, Matt, NVIDIA is worth this high price. Look at their profit margins. They have a 70% plus profit margin. Yeah, so did Cisco back in 1999 and 2000. You saw the same thing. And the question that you have to ask yourself is, do you really think 70% profit margins are going to last? Do you really think there's going to be no other company that decides to come in and start making chips and processors and all the things that NVIDIA produces that are going to compete with NVIDIA? We're already seeing a lot of companies now that are manufacturing chips right here in the United States. In fact, there's a local company here in Temecula that's manufacturing 300 mm wafer chips. We're already seeing this happen. I do not believe this kind of profit margin is going to continue. And when those profit margins drop, you're going to see NVIDIA's stock really drop. One of the big concerns we have is long-term economic stress. This is where we see things that could produce really negative results in the economy going forward. And one of the big concerns that we have is a concern that's been around for well over a year now. We saw it first come out with all of the bank failures. We saw Silicon Valley Bank, we saw First Republic, and some of these other banks that failed. And we still have that problem. There is currently, according to the Federal Reserve, $500 billion in unrealized losses on the bank's balance sheets. So if the banks had to liquidate all of their assets, they would suffer a $500 billion loss. Now, this is what the headline number is. This is what everyone's talking about as a concern, and it definitely is a concern. But the problem that I have with this number is it doesn't include any potential losses in the commercial real estate space. If you look at some of the office buildings that are underwater, let's say a bank has a loan on an office building or a shopping mall, say for $100 million, and that shopping mall is only worth $50 million, well, there's another $50 million loss, and this is each property added together that has potential commercial losses. When you start looking at the commercial real estate market and what's out there, there could be $1 trillion in additional losses over and above this $500 billion. So this is a real problem, and we're starting to see some cracks in the banking system, not here in the US quite yet, but we're seeing it out of Japan. Japan is having a real problem. In fact, one of the Japanese banks is liquidating assets in order to cover some of these losses and problems. And I am concerned that this could spread around the world. These higher interest rates have really had an impact on the underlying assets that these banks hold. Speaking of Japan, one of the concerns that we have is what has happened to the yen over the last 13 years. The value of the yen has dropped by 50% versus the US dollar over the last 13 years. This is obviously creating a lot of problems for the people in Japan. The value of their currency, they are having to pay twice as much money for the same amount of stuff that people that are using dollars have to pay. And so this has not happened here in the United States, but it is something that could come if we are forced to keep artificially low interest rates, which is what's going on in Japan and what's happened in Japan for a long time. If the Federal Reserve is forced to artificially keep our interest rates low, this could really affect the US dollar. And one of the big concerns is if the government has to bail out all these banks and create a lot of new money in the system in order to create these bailouts, what's going to happen is you're going to see debt levels explode. And we already have really high debt levels. Currently, just the interest that we owe every year, just the interest the government owes, is more than the national defense. So currently, the government is paying more in interest charges than they are for military spending. What happens if we have to add a lot more debt on top of that? So what are we doing in order to protect our client accounts and make some adjustments in light of what we're seeing? Obviously, we want to reduce our stock market exposure. We are doing that. One of the things that we're adding in, which is something that you may be surprised to hear from me, because for the last 5 years, I've been talking about how bonds were a horrible investment. Why would you put money in bonds when you have interest rate risk? If interest rates go up and then the value of the bonds go down. Well, I actually believe that we are more likely to face a deflationary situation in the short term. So bonds are actually a good spot to be. And currently we can get maybe 4, 5, 6, 7% returns. And if interest rates do go down, you'll actually get a higher return. We are obviously betting that interest rates are not going to go up. And I think that's true. There's no way that rates can continue to go up. The economy is already really struggling. We've already had announcements from the Federal Reserve that they're going to be lowering interest rates, possibly 1 or 2 cuts this year. And so it's a pretty safe bet. So we will be reducing our stock exposure and adding more bonds into the mix. This will help protect our clients from any big downturn in the stock market. One of the other things we've done recently, and you may have noticed this, it's been tens of millions of dollars, so a lot of you are affected. Any of the buffered index portfolios, which has been a fantastic investment for our clients, any of those that are maturing between now and through September, we actually cashed all of those in early. We were up, for example, on the September notes, up over 20%. And it makes no sense when you're up over 20% to hang on until September, just to get a few extra percent, especially when we can cash them in now, realize all of those extra gains, and then we can go into a new buffered index that actually has more downside protection. So for example, the new buffered index we have, the new amount would start at today's value. So if the market started dropping from here, you'd actually make money on the way down, where people that have been in for 2 years and they're getting ready to mature in September, well, any drop between now and September, they would take the full drop. So we went ahead and cashed all of those in. So we're going to be reaching out to a lot of clients over the next month, talking about reinvesting those buffered indexes. And so those are just some of the steps that we are taking in order to protect our client accounts. And I don't expect a great big drop in the markets. I don't expect a huge crash between now and the election. I think that there's a lot of incentive for the Federal Reserve to kind of keep the markets up. We're seeing money supply increase. I mean, over $90 billion in additional money supply. So the Fed's claiming that they're fighting inflation, but then they're creating all this additional money supply. So I think that will probably continue through the election. But just to be safe, we want to realize our gains. It's more important to protect your principal than it is to try to get a little higher return. Speaking of the buffered index, we have a new one. We actually just got the numbers this morning. And so this one is going to go into effect on July 31st. And unfortunately, a lot of the spreads in these structured notes have really blown out. We don't have a whole lot of options other than one good one. And it's a pretty good one. It has a 22% cap. And so it's based on the S&P 500. It goes from July 31st of 2024 to July 31st of 2026. If the stock market goes up at all between July 31st, 2024 and July 31st, 2026, you will make up to 22%. So if the market's up 10%, you get 10%. If the market's up 20%, you get 20%. Now, if the market goes up 30 or 40%, you're just going to be up 22%. You are agreeing to give up everything above 22%. But in exchange, we're able to buy a dual directional buffered index of 20%. So this means if the stock market starts to drop, and it drops during that 2-year time frame, say it's down 10%, not only do you not lose, you actually make 10%. You make the inverse return all the way down to 20%. So if the market's down 15, not only do you not lose, you make 15. If the market's down 19%, not only do you not lose, you make 19%. Now, if the stock market is down more than 20%, then it just pays a 20% reimbursement. So if the stock market was down 25%, you would still be down 5% because you'd only be reimbursed 20% of your 25% loss. Now, this is a really good investment. A lot of the buffered indexes that we cashed in recently will be reinvested in this investment. We'll reach out to you to make sure that we're looking at your individual situation and putting you in the right investment. But this will be a natural place for those people to reinvest. And the nice thing is, if the market does turn down, you actually pick up returns all the way down to 20. So this will put us in a really, really good position going forward. And so we're happy about this buffered index. I have zero other options for the buffered index. That's my one good one. And for those of you that have cash that's sitting, we're just going to wait. We're not going to invest it. We're going to let it sit until July 31st when the valuation date happens. It just doesn't make sense to go into the stock market in this short duration, especially with this kind of volatility that we might see. We just want to go into the new buffered index on the date of July 31st. Now, the multi-guarantee interest rates that are out there have come down a little bit. The MIGAs, the MIGAs, these are basically like CDs with insurance companies. All of the rates have dropped a little bit, especially on the longer duration. Some of the short-term stuff still is paying very, very high. We have an inverted yield curve still, and this is obviously a precursor to a recession, which I believe probably started last month or maybe even a little bit earlier. We'll probably get some kind of a notice sometime in the future, whether it's 6 months or a year from now, that the recession started in 2024. I think that's very likely. But the current rates are still good. They're not quite as good as they used to be, but they are still good. So the current rate we have on a 3-year is 5.32%. That's a guaranteed interest rate. What you see is what you get. There's no additional fees or charges. You get 5.32% every year guaranteed. The 5 years down to 5.02%. So we're still above that 5% interest threshold on the 5-year. Now someone might say, well, gee, Matt, why would I do a 5-year at 5.02 when I can do a 3-year at 5.32? Well, the reason is it's guaranteed for the full term. If 3 years from now the interest rates are down and say they're around 3 or 4%, the person that opted for the 5.02 is going to continue to receive 5% for the full 5 years. That's why the longer duration, even though it pays a little bit less interest, is a popular option. Finally, let's talk about the ultimate hedge against inflation and market uncertainty. That is gold. Gold has done very, very well for us this year. Gold is up 13%. Because we have such a large position for our clients in gold, we've done very, very well with that position. And even though I think deflation is coming, even though I think we could see a recession, I still think gold is going to be a really, really good investment going forward. And this is because it's such a small percentage of people's portfolio today. Now, historically, that's not always true. If you go back and look at history, usually about 2% of people's investments are actually in gold. But today, it's 1/2%. And so if we just get back to that 2%, you will see a huge demand increase. A 400% increase in demand on gold will really cause the price to go up. So in light of this, I do think gold is going to be the future. And we're seeing this, of course, around the world, not necessarily here in the US. In fact, we've seen net outflows on gold ETFs and gold investments here in the United States. People are selling gold. How is the price going up if more people are selling than people are buying? Well, there are some buyers, and those buyers are internationally. Primarily central banks around the world. They're accumulating gold at record amounts. And I think the big concern is the US dollar, the debt and deficits that we have in this country. A lot of other central banks, a lot of their countries are accumulating gold because of this, which means that we should probably be accumulating gold in our own portfolios as well, doing the opposite of what most Americans are doing. And so in light of that, I'm actually heading next week. I will be out of the office next week. I'm going to one of the largest natural resource conferences in the country that is being held in Florida. And I actually have meetings already scheduled with some of the top people at those conferences. In fact, the person putting on the conference, we have a meeting with that person. And my objective is to figure out how to best invest in gold. I do believe the gold miners are probably the best spot to be, but we want to make sure that we're really investing safely. We're looking intelligently at the various investments out there. And so I'm going to be spending a lot of time next week at that conference learning all about the gold market and possibly creating relationships with people that can help us create our own gold fund. to allow us to outperform in the environment that I see going forward. So if you have anything and you need anything from us, feel free to reach out to the office. If you need to speak with me, I will be out of the office, so certainly ask for one of the other financial advisors. They'll be happy to help you. And happy 4th of July to everyone.